In this episode, we are studying equity valuation. And equity could be stock if the company is a publicly listed corporation, and it can also be a private equity with a lump sum dollar value. And there are several ways to estimate the value of a stock or equity. So right here, we will just treat the equity just as another type of assets, and assets can be stocks, can be bond, as we previously studied, and also foreign exchanges, cryptocurrencies, real estate assets. And if we want to get a fair value of the assets, then we need to develop the streamline of cash flows generated by these assets. For example, in the previous chapter, we learned about bond valuation, and we know bond could generate coupon payments and face value. So we're going to line up all these cash flows and discount it to present values. And the present value of the cash flows will be called intrinsic value, and that's basically the true value of the assets. And if we own stocks, then the stock can generate the dividends, and we're going to discount those dividends to get a fair value of the stocks. And that comes to this model. It's called a dividend discount model. And also there are companies who do not pay dividend, like Facebook, and but still they are making money from their sales and all the operations. So for the companies that are not paying dividends, we're going to use the free cash flow to the firm, FCFF. So this valuation basically is based on the free cash flows. Could be made of capital investments, operating cash flows, salvage cash flows, and a change of inventory, and so on. And you will need to discount the free cash flows based on the weighted average cost of capital. All right, and there's a third method. It's called a free cash flow to equity, and that only happens to equity investors. So basically, the free cash flows has to be deducted by the interest payment to the debt holders. The rest of it would go to the equity holders, and then you will need to discount based on cost of equity instead of the overall cost. All right, so we're going to study this dividend discount model here in this video clip. And for free cash flows, it's going to be covered in a different video clip, like the cash flow analysis for Boeing Corporation in a different assignment. All right, so if we want to know the value of a financial asset, of course, as I said, take a stock, for example, we're going to lay out the cash flows generated by these assets. And then in the stock investments, we assume perpetuity. And perpetuity basically means forever. Of course, none of the corporations would last forever, and there's always a risk for the company to get bankrupt. The longest history for a corporation would be for East Indian Company, a Dutch company that lasts for 400 years. And that company still get bankrupted and dissolved. Still, we assume perpetuity, and if the company has higher risk of getting bankrupt, we just use a larger discount rate for the cash flows. Company with higher risk of bankruptcy, then the discount rate it would be larger, resulting in a less value. Still, we assume perpetuity. As you can see, the infinity sign is being labeled here. So that's the summation of all the discounted cash flows put together. And of course, your cash flow could grow with growth opportunity G, and that can also be incorporated into your valuation model. And right here we got a three valuation model for equity listed here. So you will need to take a look at the cash flows they use, and also the owners of the cash flows and the discount rate. Okay, so as I said in this video clip, I only focus on this part, and for the free cash flow to the firm, it's going to be different analysis, and the free cash flow to equity holders, that's going to be in a later chapter. All right, so here is a Gordon growth model, and that basically defines the valuation of a stock based on dividend only. All right, so you will get to the stock value today based on the dividend in the first period, and then the cost of equity and the growth of a dividend. All right. So right here, you got an example. If the company expected to pay a dividend of $1.5 next year, that dividend would grow 4% per year in perpetuity. The cost of equity is 14%. So what is the stock worth today? All right, so if you simply use the formula, you're going to use dividend 1 divided by K minus G. That's $1.5 divided by 14% minus 4%. So the whole thing going to give you $15. And if you use Excel to do the work, which you will need to follow exactly, so the calculation is pretty easy to comprehend. So I will need to get the price today, or the intrinsic value today, same thing. And then I have dividend in the first period and the dividend growth, and also cost of equity. And the cost of equity can be obtained by the CAPM model. You know, the CAPM is based on the market return, the beta, and the risk-free rate. So the return to the investors would be the cost of equity to the firm. So the first year dividend is going to be $1.5, and the dividend growth rate is 14%. Cost of equity cost of equity is the 14%, and the dividend growth is the 4%. All right, so you can solve for the price today. It is dividend 1 divided by 14% minus 4%. All right, so that's what the math gives to us as we follow the Gordon growth model. And you also need to do this. So you're going to generate unlimited amount of years for the cash flow starting in year 1. All right, so I select the first 2 years, and then I just extend for so many years in the future. Okay, as you can see, I have so many years labeled here, and that's a simulation for perpetuity or infinity. All right, and then I will get my dividend. And my first year dividend is $1.5. Okay, and then my second year dividend will be the first year dividend times 1 plus the 4% dividend growth rate. Sure that this growth rate will be locked, so you can just keep dragging it all the way down. So since I have an infinite amount of years, and if I drag it all the way down, double click, you can see the dividend will keep growing to an infinitely large number. However, that does not matter for our valuation process. So if I get the present value of all the dividend, all right, so I will use each dividend divided by 1 plus the discount rate, which is cost of equity. Again, log this number raised to the power of whatever year number is. Okay, so that is basically showing you $1.5 in the year later. It's going to be $1.32 in today's dollar. Okay, and now I'm going to drag it all the way down. You can see even though the dividend keeps growing, because the growth rate is less than the discount rate, 4% is less than the 14%, then the present value will keep shrinking. And if you go to the very last year, it's going to shrink to 0. So what happens if you add infinite amount of zeros? That's not going to change your summation. So right here, the present value would be the summation of all the present values of future cash flows. When I add them up, that's going to be $15. Okay, so that's one of the exercises you need to do, you need to perform. In particular, you need to solve for the price. Either use the Gordon growth model or use the summation of the present values. All right, so how could a company have a dividend growth? So here I'm opening a different exercise which you need to follow as well. So right here I have a company with a total equity, make it $100, and the company has return on equity which is 10%. That's your ROE. So each year the company is going to make net income of 10% of its total equity. All right, and then we need to know there is a retention ratio. Retention ratio is amount of net income being retained to the company as retained cash, and it will be built to the retained earnings, which is part of the total equity. Let's say right now the company has 80% of the cash retained for future development, and then the rest will be paid as dividend. and this is called a dividend payout ratio. And that is 1 minus whatever the retention ratio is. If 80% is saved, 20% will be paid out as dividend. Now right here, I'm going to generate several years from year 0 all the way to year 10. Okay, and then I need to build the total equity. You start here as $100. And then I will need to figure out what is the net income made in this year with the same, a constant return on equity. So the net income will be the total equity multiplied by the return on equity. So if you have $100 in your assets, then that's going to be $10 net income you make. All right. And then you need to tell me what is the retained cash and what is the dividend payout. Okay, the retained cash here would be the $10 net income multiplied by the retention ratio. You're going to lock it. All right, and the dividend payout would be the net income multiplied by the dividend payout ratio, and lock the payout ratio as well. And previously, I forgot to lock this ROE, return on equity. Now I'm doing that. Okay. And then for the next year, since the $2 dividend is paid, that makes $8 being saved. And that saved to total equity, your total equity will grow by $8, okay, to 108. And then you will need to figure out what is net income. So the net income will be 10% of total equity. That's going to be $10.80. All right. And then for the retained cash, so that's going to be the 80% of the net income, and for the dividend payout, that's going to be 20% of this net income. And then I'm going to replicate the same calculation for all the future years. As you can see, the retained cash is being added to the total equity in the next year. And right here you have more retained cash, so that's going to increase your total equity by the same amount. And for your dividend, so let's solve for the dividend growth rate. So you can use a later dividend divided by an earlier dividend, then -1. So that's 8%, so to speak. All right, you can also simply use return on equity multiplied by retention ratio. All right, that's also 8%. So the underlying theory is the more money being saved by the company, then the total equity would grow larger, then the company can make more net income, and then the dividend can grow at a higher rate. Okay, so if I change 80% to 20%, so instead of 80% of the net income being retained, I only retain 20% of it. That means 80% of the money will be paid as dividend. You can see the dividend will start large, but the dividend growth rate will be lower. Okay, so if I change this to 60%, 40% combination, then the dividend would grow at 6%. All right, it will grow at 6%, but the dividend will start a little lower than the previous case. Okay, so you can leave this setup as I did here when you turn it in. So what I really want you to remember is the dividend growth rate can be determined by the return on equity and the retention ratio. It is basically the product of the two. Or you can lay out a table like this showing the total equity, how it grows based on retained cash, and how the dividend is paid out, and then solve for dividend growth. The same way you can get the growth rate of the dividend. All right, next practice, which you also need to turn in. So this is directly come from the PowerPoint, the textbook. So my number is a little different. That doesn't matter for the sheet number. Okay. So this time you have two growth rates. Okay, so we examined Cisco company, and it had a 53 cents dividend in the year of 2000, and you think the dividend per share will grow at 20% per year for 5 years, first 5 years, and then the growth rate will subside to 5%. And it would be its long-term growth rate. So you have two stage of dividend growth. First at 20%, and then at 5%. The total equity is 12%. All right. So how could you get the stock value today? This is the textbook method. So it lays out 6 years of dividends, and then solve for terminal value at year 5, and then discount all these cash flows to get the value of the stock. All right, so let me just show you how we solve this step by step using two different methods. You need to follow both of them. So you have calendar year of 2000, and you also have 2001. All right, so I'm going to generate infinite amount of years. Of course, it can be infinite because Excel can only contain 120,000 rows. So 500 is a good amount, okay? All right, and then I have all the dividend here in this column. So you start with 53 cents, and then it will grow by 2%. So let me just put a G1 as 20%. Sorry, 20%. And G2 will be 5%, and then the cost to equity, which is your R or K, is 12%. All right, so let it grow by 20%, 1 plus 20% for the first 5 years. Lock this growth rate, okay? And then all the way to 2005. Make the format a little bit nicer. And then starting from year 5, then it will grow at a rate of 5%. Okay, each year just grow by 5%, so on and so forth. Okay, so just like the previous practice, you can see the dividend keep growing to an infinitely large number as the year approaches to infinity. But if we apply the discount for the present values, and you can see that for dividend 0, there gotta be no discount, but still I need to set up the formula here, lock the discount rate, raised to the power of 0. So 0 comes from 2000 minus itself, or just minus 2000, the number. Okay, so there's no discount for this one because the exponent of the discount rate is 0. But if I double click, you will see that for the next year, the exponent is 2001 minus 2000, so that's 1. So that's 1 year discount with the same discount rate and dividend in the first year, and so on and so forth. All right, the next thing we're gonna do is to get the value of the stock, okay, or price as 2000. Okay, so we assume today is year 2000, and you're gonna add all the cash flows in the future. Exactly. So you do not include the year 0's cash flow. Okay, no, you don't include this present value of 2000. All right, because that dividend was already paid, and that does not belong to the streamline of the future cash flows. So you only count for the dividends starting in year 1 and all the way to year infinity, and then add all their present values together. Okay, so that's the way to solve for it using Excel simulator. But if you are tested based on a paper test, okay, then things gonna be a little bit different because you wouldn't have access to computer power to have all these many years of cash flows generated, simulated for you. So you have to solve for additional things. So if you want to solve for it, you need to solve for the price as of 2005. Why is that? Because after 2005, the dividend will grow at the next stage and at a rate of 5%. So you will need to use the growth model. So you're going to use the dividend in the next period, which is the dividend 6 divided by the 12%, the discount rate minus 5%. Okay, so this is how you solve for the stock price 5 years later. So instead of holding the stock for an infinite amount of years, receiving infinite amount of dividends, you hold it for only 5 years. During these 5 years, you receive dividend 1, dividend 2, all the way to dividend 5, and then you sell it. You sell it at a price of $19.78. So that's the stock price in year 5. Okay, and how do you get your stock price as 2000? Okay, let me just delete this. So I'll just put it here. It is actually the net present value of 5 years of cash flow. And you have 12% as a discount rate, and you have a cash flow 1, which is a dividend 1, comma, dividend 2, comma, dividend 3, dividend 4, as the first 4 years of a cash flows. And for the 5th cash flow, you're gonna put dividend 5 and stock price 5 together. Okay, so you get the net present value for all of this. You will get the same result, which is consistent with the textbook. So this is what you're going to solve for the stock value if you have 2 stages of a growth model. And of course, there's a third way, but I'm not going to teach you that because this is the third way. The textbook is showing you if you rely on the mathematical formula to solve for that, that's going to be this tedious, giant, monstrous formula. So you're going to have the discount rate as K, you have a growth rate 1, growth rate 2, and then the cash flows in the first stage, and so on and so forth. So this is not applicable if you are not very mathematical savvy. And I think the best bet is to use there's 2 methods, okay? If you have computer power, you run this. If you don't have the simulator, then you run this 2-stage model. Basically, you need to solve for the price at the end of the first stage. So between 2001 and 2005, that's the first stage. You need to solve for the price at the end of the first stage and then incorporate it as one cash flow, part of the last year's cash flow in the NPV calculation.